Hi everyone, I'm James Harte from littlefishfx.com. Thank you for joining me for this week's Forex Education Hour. In this session, we're going to take a look at one of the most popular Forex indicators, and that is of course the classic RSI indicator. Now, for those of you who are familiar with Forex trading, I'm sure this is an indicator that you've probably come across quite a bit. It's used in a lot of different educational material, and it's used by a lot of the traders of all variety of skill levels. So you've probably seen countless charts with the RSI indicator included. Now, for those of you who are new to Forex trading, again, this is an indicator that you're likely to see pop up quite a lot. And so it's good to get a solid understanding of what it is and how you can use it. And indeed, should you use it at all? So that's what we're going to talk about in today's session. Exactly what the RSI indicator is, the different ways that you can use the indicator from the basic methods through to more advanced ones. And we'll also look at some of the downfalls of the indicator and some of the traps that you need to be careful to avoid. So as ever, if you have any questions during the presentation, please just type them in the chat function and I'll be sure to stop as we go along to answer the questions. So first of all, what is the RSI indicator? So the bottom line of the RSI indicator is that it's a momentum indicator, meaning it measures the underlying strength in the market and identifies price swings as either overbought or oversold or somewhere in between. And it's looking at the strength of recent gains versus recent losses. So the indicator looks like this, okay? It's typically seen in the bottom panel of a price chart. And you'll see the indicator itself is set up with two levels marked already. So we have the 70 level to the upside, marking what is typically seen as overbought. And then we have the 30 level on the downside, which is marking what is typically seen as oversold. Now, these levels are adjustable and you can make them more or less extreme, but these are the standard settings alongside a 14-period look back. So it's looking back over the last 14 sessions. So if we're on a daily chart such as this, it's looking back over the last 14 days. If we were on an hourly chart, it would be looking back over the last 14 hours. Now, changing the period makes the reading more or less sensitive. The further you go back, the less sensitive it is to price, and the closer you bring the period, so the shorter the look back period, the more sensitive it is. Again, 14 is the default setting that you'll find with the indicator on most platforms. So this is the RSI indicator, very simple, very straightforward. It measures the underlying momentum in price. Once it hits 70, it suggests price is overbought. Once it hits 30, it suggests that price is oversold. So one of the most common ways to use the indicator, and which you probably guessed by now, is looking to fade price when the indicator moves into extreme levels. And by fade, I mean looking to trade an anticipated reversal in price. So we know that when the indicator moves into extreme levels, that it's suggesting overstretched momentum in price. So we can then look to capitalize on this by trading a reversal or anticipating that a reversal will occur. So let's look at an example and talk about this a little more. Okay, so this is a daily chart of sterling dollar over a roughly 6-month period. And you can see highlighted on the chart, there have been quite a few occasions where the RSI indicator has moved into extreme levels. And look how price has reacted each time we've moved into these extreme readings. So first of all, we saw price trading up into this April high here, and we can see that RSI was moving up into overbought territory, telling us that there was a lot of bullish momentum in the market. You can see RSI actually topped out once we hit the 70 level and corrected lower. And price actually corrected lower in line with it, okay? So momentum faded to the downside, buying weakened, okay, and we corrected lower before we made another run higher, okay? So we broke past that initial high to trade new highs, and you can see that the RSI indicator again moved back up into overbought territory, again signaling that there was extreme bullish momentum in the market. And you can see that once again, this bullish momentum was exhausted at this point, and we corrected lower once more. We actually got a much deeper price correction this time, in line with a much deeper correction in momentum, before once again we took another stab at the upside. So we pushed past both of those initial highs to trade yet a further new high. And once more, you can see RSI traded up into overbought territory. Okay, we hit that 70 level, probed it slightly, and then you can see that once more, that bullish momentum was exhausted and price corrected lower as momentum also corrected lower. We then got this period of chop in the market where we were basically just moving sideways. However, you can see from this point here, we started to sell off sharply. And as we pushed lower, breaking past these key supports, you can see that the RSI indicator actually moved down into extreme oversold territory. And then from this point, we saw price correct higher as momentum corrected higher also. So just like we saw at the top side here with the indicator telling us that there was extreme bullish momentum in the market, okay, overbought momentum, and we saw this correction in price. Well, here we've seen the indicator telling us that there is extreme selling momentum, okay, and we've got exhausted bearish momentum as price corrects higher. So if we think about what the information is giving us and how we can use this, okay, you can see that the RSI indicator works as a really good trade filter and a really useful tool in filtering our trades and timing our trades, okay? If we're looking for a short entry, we really want to see the RSI indicator in overbought territory or just moving down from overbought levels, and vice versa. For a long entry, we want to see the RSI indicator either in oversold territory or rebounding off oversold levels. So using the RSI indicator as a reference for timing the market can be a really great way to use the indicator. And again, it's similar to the method that we talked about in the stochastics webinar, okay? This way of using the indicator can be extremely helpful in conducting our multi-timeframe analysis, whereby we look to identify the dominant direction of price on the higher time frames, or the dominant momentum, and then look to the lower time frames to try and align with that direction and with that momentum. So in this chart, we have the Australian dollar over the last year or so on the daily time frame. Now, again, note the instances where the RSI indicator has moved into extreme territory, okay? And note the response from price, the typical response from price, which is a correction. So you can see that initially we correct higher from these oversold levels here. We then trade up. We move up into these highs, the RSI hits overbought levels, and we correct lower from these overbought levels. We then chop around before again pushing yet further lower. We move down into new lows, the RSI indicator tags oversold levels, and we correct higher again, okay? We can then see that once we pushed up into this most recent period of price action here, the RSI indicator was flagging up oversold momentum. We moved into oversold territory, okay, but we didn't get that exhaustion in bullish momentum. We didn't get a correction lower. So over the last year in the Aussie dollar on the daily chart, of the 4 times that the RSI has moved into extreme territory, we've seen a reversal in price 3 times. So 75% of the time, the RSI indicator has yielded a price reversal once it's flagged extreme momentum. So what does that information tell us in relation to the price action and how it can help us in our analysis? Well, let's think about what actually happened over that year and how traders might have been thinking at the time, and maybe the sort of trades that we might have been looking to place. So we can see that after we corrected higher from this initial oversold level, we made a reaction high, then turned lower, tested that low again, failed to take out the low, and instead we actually turned higher and broke past that initial reaction high. So at this point, we might have been thinking, right, we're on a breakout here, okay? We failed to break to the downside. We've taken out this reaction high. We've got good bullish momentum here. We can see this sustained run of bullish candles. So we're probably looking for breakout trades. However, if we look at the daily RSI, we can see that price has clearly moved into oversold territories. So we've moved up into oversold territory, and then what happens? We actually get a reversal lower. So we don't get that sustained breakout, which we might have been anticipating if we were just looking at the naked price charts alone, and actually price corrects lower. So once we turn down from this point, we can see that we trade back down, retest that second low, trade back up, retest that new high, fail to break that high, turn lower, and at this point we actually break sharply lower and break down through these lows. So at the point that we break down through the very low of the period, the low which held price from September 2015, we probably were thinking about getting short. Okay, we've taken out this big low. This is a really important structural level. We've got this big bearish bar, and we're probably looking for shorts. But again, if we reference the RSI indicator, we can see that the indicator is actually flagging oversold. Okay, we've moved into extreme negative territory on the indicator, and again, look what happens. We get that correction to the upside. So you can see here how consulting the RSI indicator could have kept you out of making losing trades in that period, anticipating those two breakouts. Okay, we got the break of two very important structural levels in that period, and at each point it probably would have been quite easy to assume a continuation bias, to assume that we were going to get a sustained breakout. But referencing the RSI indicator would have kept us out of those losing trades. So including the RSI indicator in your multi-time frame analysis is definitely another great way that you can look to use the indicator. So this is the bottom line of the fading method. As I say, it's very simple. We're waiting for price to move into extreme levels, anticipating that momentum is exhausted, and then looking to fade price, trading a reversal, so trading a correction back. So as price moves higher and hits overbought territory on the indicator, we look to sell, anticipating that we get a correction lower. And as price trades into oversold, extreme oversold territory on the indicator, we look to get long, anticipating a correction higher. However, if we look at what happened at this point here, this is an interesting factor of the indicator. We can see that as price traded higher, as we took out this clear resistance level, the indicator was obviously flagging overbought momentum. We moved into extreme overbought territory, but price continued higher anyway. We can see that we actually first tagged the 70 level around this point here, so around the 74 mark, and we ran higher by almost 300 pips. So this is one of the flaws of the indicator that we need to take into consideration. As I say, fading the RSI is the most common or the most basic way to use the indicator, but is it necessarily the best way? It looks very straightforward, it seems to work well, but the issue is that using the RSI indicator to fade overbought and oversold levels works very well in range-bound conditions where price is simply rotating back and forth, making nice large swings such as we were seeing here. However, once price really starts to trend and push hard in one direction, it can be very difficult. The indicator rather can get into great difficulty, and it can be quite a sticky situation if you're looking to continue to fade the indicator. You can see here that the indicator made several attempts on the 70 oversold level whilst price just continued to push higher. So we'll move on and look at the difficulty in this now. Before we do, are there any questions I can answer at this point? Okay, great. Well, as I say, if you have any questions at any point, please just write them in the chat function and stop as we go along to answer them. Okay, so look at the price action in the sterling dollar chart again the daily chart, over this 12-month period. So after topping out in summer 2014, you can see that price has been in quite a sustained bearish trend, selling off relentlessly down into the lows of spring 2015. Now, look, as price made its way heavily lower from those summer highs, look how many times the RSI indicator flagged that momentum was oversold. Look how many times we moved into extreme oversold territory here, hitting that 30 mark. There were roughly 7 occasions during that period that, using the traditional fading method of the RSI indicator, would have seen you entering losing trades as you were trying to buy cable as it simply continued to crash lower, despite repeated attempts at the oversold, repeated tests rather, of the oversold territory on the indicator. So trying to fade the RSI indicator in trending conditions is effectively, as we say, looking to pick up pennies in front of the steamroller. Okay, it can be a very dangerous method of counter trend trading in a very fast way, very easy way to lose money. So does that mean that the RSI indicator doesn't work and that you should discard it? Well, absolutely not. We've simply identified here 2 sets of conditions, one where the RSI indicator works very well and one where it doesn't work particularly well. So there are a few solutions. Either you can look to fade RSI in range-bound conditions only, or you can look to modify how you trade it in trends. For example, you could build into your rules that after you take one losing trade in one direction, you'll wait to trade only the other side of the RSI spectrum. So in this example, as price is selling off, we might get long here as price tests the oversold level. However, once price fails to bounce properly and the indicator tests the oversold level again, we would stand aside. Okay, so once we've taken one loss in one direction, we would stand aside and wait only to take a trade once the indicator has moved up to the other side of the spectrum. And you can see that once we got the initial oversold reading here in August 2014, it wasn't until May 2015 that we actually got our first trade from the other side of the RSI spectrum. So price continued to trend lower over this period. The RSI indicator continued to plumb oversold territory, but we stand aside, wait for the indicator rather to touch the other side of its spectrum. And at this point, we get our first short trade. Now, as you can see, that keeps us out of this entire downtrend. But you might be thinking, however, that means I only get one trade in a year. So 2 things. First of all, no trades is better than a succession of losing trades, definitely. And 2, there are a whole range of currency pairs and markets. So whilst one pair is ranging rather, another pair is trending. So there are always going to be markets that you can trade. And the key thing is identifying favorable conditions for your strategy. So it's important that you can think to yourself, right, I'm looking to fade price using RSI. So I want to find range-bound markets where I know that the RSI fading method tends to work well, and I want to stay away from trending markets. So then you start to find the best ways to measure these conditions objectively, and before you know it, you have a fully fledged trading system. So these are definitely the sort of considerations that you need to be thinking about whenever you're looking at an indicator or looking at a new trading system. Okay, there are very, very few systems out there or indicators that work well in all market conditions. So you always need to be looking to optimize your strategy in the periods that it works best, and then looking to step aside or use something else in the periods where it isn't working well. So for the RSI fading method, we've identified range-bound conditions, such as we got here, tend to work very well, but trending conditions don't work too well. So we look to stay out of trending markets, or we look to modify the way that we trade trending markets using the RSI indicator to make sure that we don't just continually get hit trying to trade from the counter trend perspective. Now, a slightly more advanced way to trade the RSI indicator is to use RSI divergence. So when we look to fade the RSI indicator, we are looking for momentum to signal exhaustion by flagging extreme levels. So we're simply looking for the indicator to move and touch the 70 level to register overbought momentum, looking to play a reversal lower, or we're looking for the indicator to move to the downside and hit the lower limit, the 30 level, looking to fade an exhaustion of bearish momentum and a correction higher. But when we're looking for divergence, we're being a bit more strategic and a little smarter in how we're using the indicator. And with divergence, we're looking for situations where the indicator doesn't support the moves that we see in price, and so suggests the reversal is likely in this respect. So let's take a look at an example and I'll explain this. Okay, so if we go back to our original example of the daily sterling dollar chart, we can see that as price made this initial high in May, the RSI indicator was overbought. Okay, so it was signaling extreme bullish momentum in the market. We can see then as price traded up and made this second high, made this new high, the RSI indicator was actually showing overbought momentum, but at a more extreme level. So as price traded higher, buying was also stronger, supporting the move up. Okay, so the indicator was registering a new high in line with the new high in price. However, if we look at the difference when price traded up and made this third high, and what turned out to be the final high in this period, you can see that the indicator didn't make a new high. So although price went higher and traded up to a new level, the indicator failed to move up to a new level, showing that unlike in this instance here, where a new high was accompanied by a new high in the indicator, showing increased momentum, at this point, the new high in price wasn't accompanied by a new high in the momentum indicator, the RSI. And so we can see that momentum has actually waned at this point. So although we've pushed higher in price, the indicator is showing us decreased momentum, signaling that the move is likely to reverse, that a correction is likely, as there just isn't enough momentum behind it to sustain the bullish move. And as you can see from that point, price falls off, it sells lower. Similarly, if we look at the downside here, we can see an example of bullish divergence. So we see price sell off into the September low. We get an oversold reading on the RSI indicator. We then correct higher before trading back down and breaching the level to make a new price low. But look at the RSI indicator again. As we make this new price low, we fail to make a new low on the indicator. So the RSI itself fails to make a new low, showing that there is less bearish momentum in the market than there was at the time of making this previous low. And once again, price corrects higher. So this is exactly the inverse of the situation we saw here, where price pushed higher to make a new price high, but the indicator was signaling to us that there just wasn't momentum in the market. So there wasn't increased momentum, there was actually decreased momentum. And this lets us know that the move is likely to fail and it's likely to exhaust and correct. And it's exactly what we saw at the downside here. Price pushed lower, made a new low, but the indicator failed to make a new low, signaling to us that bearish momentum was weakening and we got that correction higher. So essentially, looking for RSI divergence at a level, at a good structural level, instead of just fading the extreme indicator readings, is a more conservative approach because we're waiting for extra confirmation on the move. So we aren't just getting in as the indicator moves into extreme territory. We're waiting for this second factor, this second component to present itself, signaling to us that a reversal is likely. And this approach can be particularly useful at key support and resistance levels, where often we can use the divergence to highlight the likelihood of price reversing from these levels. And indeed, it can actually be a useful tool for avoiding false breakouts, because if, for example, we were looking to trade a breakdown through this support, then we would want to see more bearish momentum in the market. So we want to see the RSI indicator making a new low, signaling to us that the move was likely to continue. So if we look back at the bullish example, okay, we can see that as price pushed through this initial high, as we broke higher to make new highs, the indicator was actually registering increased momentum in the market at this point compared to this point. So the indicator was signaling to us that there was still good bullish strength in the market, and as price pushed up to make new highs, the indicator too was pushing higher, and you can see that we broke above this high by a couple of hundred pips, so this was a decent breakout opportunity. However, if we were looking to take the same breakout trade at this high, then it would be very clear to us that there just wasn't the same bullish momentum in the market. So unlike with this situation here, where as price took out the high, we had further highs, new highs in the RSI indicator. Well, at this point here, as price took out this high, we can see that the RSI indicator was much lower than it was here, showing that there is decreased bullish momentum in the market at this point than compared to this point. And so the move isn't likely to be sustained. And you can see that we actually reversed lower from this point. So this can be a really useful tool in looking to time our trades and filter our trades, and also avoiding false breakouts in the sense that we just discussed. So we've looked at some basic uses for the RSI indicator now in terms of using it to fade overstretched momentum, anticipating a reversal. We then thought about it a little deeper and got a little more strategic, and we've looked at how we can use indicator divergence to trade reversals also. So now let's move on and take a look at some advanced methods. So firstly, we just saw that divergence is really effective in trading static support and resistance levels, but it can also be really useful for trading dynamic support and resistance structures such as channels, okay? And in fact, one of the main ways that I personally use the RSI indicator is that I like to highlight divergence in channels. So the same principle applies. We're looking for a move in price which isn't supported by the RSI indicator, again suggesting that a reversal is likely. So let's take a look at an example, and just to reiterate, if you have any questions, please just write them in the chat function and I will stop to answer them. Okay, so here we have an example of sterling dollar on the 2-hour charts, and we can see that it's displaying clear divergence within the channel. So let's talk about what's happening here. So first of all, we got this really sharp sell-off in cable at this point, but we then flattened out and started to grind lower. And we were moving lower in this really neat channel formation, respecting the upper and lower limits of the channel really neatly. For those of you who saw the trend lines and channels webinar, you'll know that we plot these channels very simply just by connecting a trend line running. So in this instance, a bearish trend line joining these two highs. We then clone the trend line and move it to the downside, and that gives us our channel. So we had price moving lower in this really clear bearish channel formation. But look what the RSI indicator is doing as we move lower. So notice how instead of moving lower in tandem with the bearish moves in price, confirming bearish momentum in the market, the indicator is actually drifting higher, showing that bearish momentum or selling momentum is fading and bullish momentum is building. So in the same way that RSI divergence into key structural levels suggests to us that momentum is waning, alerting us to a potential reversal, here we're seeing price moving in a clear technical structure. So we're clearly moving to the downside, but momentum is waning, alerting us again to the potential of a reversal. So this is a really great situation to watch out for in the markets, where we have these clear channels in place. And RSI is showing divergence. So we can see that as price is pushing down, making these new lows, the RSI indicator is moving to the upside. So price is making new lows in this clear channel. The RSI indicator is making higher lows. So it's showing us clear divergence. So once we see this set of circumstances develop, we then want to keep an eye on the price action, monitoring or anticipating a potential reversal higher. You can see that that's what happened here. We actually broke out of the bearish channel resistance line and took off to the upside, in line with the direction signaled to us by the divergence in price. So again, exactly in the same way that we saw with RSI signaling divergence at key structural levels, we're getting exactly the same picture here. We're just looking at the market with a little bit more technical analysis. So we're moving lower, we've got this clear channel, and we're moving lower in this clear channel, and we've got the RSI indicator moving to the upside, alerting us to the fact that bearish momentum is waning and we could be about to take off to the upside. Okay, so Alden asks, what settings do you recommend? 70, 30, how many periods? So basically there are a lot of different theories about which settings to look at, but the way that I think about it is that the majority of traders looking at the RSI indicator are looking at the 14 period. So I think it's good to have an eye on that, to keep an eye on how other traders will be viewing the markets. Now, with respect to the limits, so the 70 and the 30 limits, obviously the closer you bring these in, so if you went as low as say 60 and 40, then you're going to get far more overbought and oversold readings. However, they're probably not going to be as reliable. You're going to get a lot of false signals. 70 and 30 are the default settings. You could take that up a notch and go to 80-20. You could even go to 90-10. And then you would really be highlighting the very extreme levels on the indicator. So, for example, if we look at these points here, we've actually gone sub 20 at this point. Again, if we go to the upside, we've actually gone above 70, but not as far as 80. So with respect to the actual limits, it's really a question of playing around with the settings yourself and finding some settings that you feel comfortable with that work well for you. Again, 70 and 30 are the default, but you can make those more extreme if you find that more useful. So, as I say, looking out for these situations in the markets where we get these clear channels present and we get RSI showing strong divergence can be a really great alert for a potential breakout trade and or trend reversal. So here we have a really nice current example. I think this actually might have moved on further now. I made this screenshot yesterday, or the day before rather. This is Swiss yen daily chart, and you can see that we've been moving in this really well-defined bearish channel since June last year. And again, the channel is identified really simply. We attach the bearish trend line from this high to this high. We then clone it and attach it to the first significant swing low. And you can see that price then traded down, found good support at that channel low, which confirms the channel. So for those of you who haven't seen the trend lines and channels webinar, please check that out if you're interested. So we've been moving steadily lower in this really neat bearish structure. But again, look at what the RSI indicator is telling us. So you can see that as price continued to forge lower ground, each new swing low originally was met with a new low in the RSI indicator. So a new low here was met with a new low. A new low here was met with a new low, and a new low here was met with a new low. So the indicator up until this point was confirming bearish momentum in the market. However, from this point here, we get that interesting dynamic starting to present itself. So as price continues to forge lower, the indicator is actually starting to move upwards. So although price is continuing to move to the downside, the indicator is starting to put in higher lows, suggesting to us that bearish momentum is starting to wane in the market and bullish momentum is starting to build. So again, once we start to see this develop, then we need to be on the lookout rather, for potential signs of a reversal. Now, this isn't a cue to just immediately jump in counter trend and start buying. This signals to us that we could potentially be in store for a reversal. And so it's up to us to then monitor the market and keep an eye on signs that this could be developing. So this is a great example of how we can use the indicator in our analysis to develop trade ideas. And this is definitely a pair that I'll be keeping an eye on over the coming days and weeks. You can see that we're very close now to testing that bearish channel resistance line. And so in line with this bullish divergence in the RSI indicator, if we break above that level, then we could be looking at a much deeper correction higher. So finally, the last way that we're going to look at using the indicator is how you can trade RSI channels themselves. So another really advanced way to look at the indicator is channeling it in the same way that we can draw trend lines and channels on the price charts. We can also draw trend lines and channels on the RSI indicator itself to create trading opportunities. Now, my preferred way to employ this option is to look for RSI channels which form during clear price trends. So let's say we have a clear bearish trend. I like to identify a counter trend bullish structure forming on the RSI indicator, allowing me to trade a failure in line with the dominant trend. So looking at this example in sterling yen, this is a 240-minute chart, 4-hour chart. We can see that sterling yen has been selling off in this clear bearish trend from the December 2015 highs. You can see that price was pushing down, making new lows. RSI indicator was making new lows too, up until this point here, where we can see that the RSI indicator actually started to grind higher. So we actually started to put in a series of higher lows, even though price was continuing to move to the downside. And in fact, this building bullish momentum is so orderly that we can actually apply a trend line to it. In exactly the same way that we'd apply a trend line to price, we can apply a trend line connecting the higher lows on the RSI indicator, which allows us to visually monitor the progress of momentum in the market. So the setup that I monitor when I identify these conditions materializing is a simple breakdown of the RSI channel. So if we look at the first RSI channel rather, we can see bullish momentum building over late December. We then see the RSI break lower through the bullish trend line, and look at that point on the price chart, look at the bearish candles that we get here. So this would have been the point where we'd be looking to initiate shorts in the market, where we'd be looking to sell in line with momentum turning lower again, in line with the broader dominant trend in the market, which is to the downside. So we sell off, price continues to make new lows, the indicator turns lower. You can see we're well below the oversold territory on the indicator here. And then again, from this point, we start to grind higher and we start to diverge once more. So although price is continuing lower, we're starting to move higher in the RSI indicator itself, showing that bullish momentum is building in the market. You can see that we get quite a decent sustained correction higher here, and price continues to, in the RSI indicator rather, continues to move higher up until this point here where we start to turn lower again. And you can see at this point here that we actually break through that rising trend line that we've attached to the higher lows in the RSI indicator. So we break through, we get this series of bearish candles here, and then we collapse lower in line with the broader dominant trend in the market. So this is another really excellent way that you can use the RSI indicator, and it works really well in helping you to find entries to trending markets. So instead of identifying counter trend phases of price action and looking to trade the failure in line with the dominant trend, we're looking to identify counter trend phases of momentum where we can trade a failure anticipating a resumption of the dominant trend. So if we think about what we're seeing in these situations, we're seeing price moving within a dominant trend. So in this example, dominant trend is to the downside. And then RSI is actually highlighting the plight of those in the market who are against the trend. So where we have this broad downtrend, you can see at this juncture here, we're starting to see some buying in the market as demand is starting to build. Buyers are desperately trying to drive price back up. However, at this point here, we can highlight the failure of this bullish momentum. So the point where the counter trend buying is exhausted and momentum once again is in sync with the dominant trend, and we move sharply to the downside. Now, sometimes this counter trend momentum will build in sync with a move in price, such as we saw here, where we got that big corrective rally in price in line with this building bullish momentum. But other times, such as this point here, we won't get that synchronicity. We'll simply get price continuing to trade in the direction of the trend even though the RSI is moving counter trend. And so this is where it can be really particularly useful in helping us to gain entries to a market where we might otherwise struggle to enter. So as price is pushing lower here and we aren't getting much in the way of a pullback, we can look to use these sort of methods to trade a continuation. So where we don't get much consolidation in the actual price chart or much counter trend action, we can then look to the indicator itself to help us gain entry once we've identified these counter trend phases and waiting for their failure to develop. Okay, so we've taken a pretty in-depth look at the RSI indicator here, from very basic and classic RSI fade right through to using RSI channels. The question is, should you use the RSI indicator at all? Well, as with any and all trading tools, there are pros and cons. We've seen how the RSI indicator can highlight great reversal trades in range bound conditions, and we've looked at how it can tend to underperform during trend phases. We've also looked at some advanced methods that can help you to take advantage of specific conditions when presented. And really, it comes down to you as the traders to test the methods yourself, see how well you can trade them. And remember that, as with all tools and strategies, it simply just comes down to how well you can trade them and how well they work for you. So I hope you've enjoyed this presentation, and I look forward to catching you next time. In the meantime, please head to the website www.littlefishfx.com and check out all of the great stuff there. We've got a really vast range of free educational material, as well as the Forex Master course. We've also got the live trading room, daily trade ideas, and daily Forex reports. We've just closed out another profitable month on the daily trade ideas. So please head to the website and check that out. And I look forward to catching you all next time. Thanks a lot.